Time to debate. My buddy Darren posted this tweet storm about passive investing versus active investing and what he thinks about it, and then he asked me what I thought about it. So it's time for a video response. And please, at any time, please go down and comment on what you think about all this. Would love to hear it. You guys are a lot smarter than me, so I want to hear your opinions. And Darren is a lot smarter than all of us. He is a derivatives trader, super smart guy. I actually met him through Tyler from MacroOps, who is another really smart quant guy. I remember Tyler is the guy who wrote this options trading report that gets deep into how options work, why volatility is so important. And you can check out this guide for free. I'll send it to you for free. Just sign up. I'll put the link right above me or down below in the comments. Just put your email in, I'll send you the report. But this report with all the volatility and stuff, it'll show you a little bit of what Darren does as well. A lot of his trading, from what I understand, has a lot to do with volatility and measuring it and finding the edge in that. Like I said, or did I say that? Like, Darren is super smart. I'm gonna put a link to his Twitter so you could follow him. But I'll be honest, some of the tweets he puts out, it's over my head. Like, I know some stuff, but not all that stuff. But if you're interested in things like volatility and trading that, Darren is one of the best people to follow, so go check him out. But okay, let's go into what he was talking about. So he said, although fads in the investment industry come and go, I do think that the passive crowd and their huge AUM, which is assets under management, will win out. I think active trading and investing will be reduced to a small fraction of do-it-yourselfers who are into being self-sufficient. The writing's on the wall. Also, I'm not sure why the gatekeepers in financial media and asset management don't just live and let live. The smugness and hubris to think that we, free individuals in a free market, need you to make or lose money for us is the biggest lie ever told by the investment industry.
I'm rich, older, and educated, so therefore if I can't beat the markets, you must hand over your hard-earned money to me so I can collect fees.
That's the main idea behind every efficient market think piece that's being written in support of passive indexing. You're absolutely crazy to think I'm going to give you a dime of my money to go out and buy SPYs and TLT every quarter and shrink all accountability when the inevitable 50% drawdown comes. I would seriously rather allocate to non-BS artist traders that are busting their ass off to earn a respectable risk-adjusted return and that are honest about their fees and goals. If not me, then the traders that I know personally and respect would be much better stewards of my money. Okay, let's break down what he's saying. So first off, he's saying even though he's not a passive investor, he thinks passive investing is going to win out. And it kind of is winning out right now. 50% of all the money coming into markets each quarter, it's all passive. It's going into index funds and ETFs and things like that. Right now, we're in a time where people just hate active investing. They don't like the managers, they're underperforming. They've had this easy bull market for so long that passive looks just beautiful. Like, why would you do anything else, right? So Darren does think they're going to win out. But what he finds ridiculous is that these guys like financial advisors and asset management guys, they expect all these people to just give them their money so that they can just throw them into an index fund for them and somehow they're earning fees on that. So Darren is saying, why would I pay you to take my money and put it in SPY, which is the S&P 500 ETF? Like, why do you deserve a paycheck for that? Especially when this strategy is going to get killed when the market crash comes. Because it's buy and hold, right? That's passive investing. Put all your money into the ETF or index fund and just hold it. That's it, no active management. Darren would much rather give his money to guys who have risk-adjusted returns, which means they are capping off their downside. And when you look at risk-adjusted returns, you look at how much of that downside they could cut off, and then you evaluate their returns. So if they don't perform as much as the S&P one year, you're still happy because guess what? They had your back. They had your risk under control. So with their strategy, you would never face that 50% drawdown. So that's risk-adjusted returns. So Darren is saying he would much rather give his money to those people than these financial advisors. Okay, so here's what I think. And please put down what you think in the comments down below. I'll respond to all of them. So first off, about passive investing winning out. It might. I mean, that's possible. But I also think half of all money coming in going to passive, I think that's a result of the cycle that we're in. We're so late stage that, yeah, everyone thinks like, why would I give it to an active manager? They're underperforming. I rather go passive, even if it means giving it to a financial advisor or someone who's going to take a cut, because it'll still be cheaper than active. But passive has been doing wonderful since 2009. Why would that change? Well, Darren, you and me both know that's going to change because markets go through cycles, right? So when the next crash comes or the next bear market, I don't think all these people are going to stay in passive. They are going to flood out because then they're going to be looking for those same active managers that are actually doing better than the index in that type of cycle. And what's going to happen, say if we had another crash, they're going to get out at the worst time, right? Because that's what always happens. Because buy and hold, it's not a bad strategy as long as you're in the US, right? As long long as you're not in Japan or something. You could make returns with buy and hold. But the issue why the average person doesn't make those returns that you should get from tracking the index is because they can't control their emotions. They are going to sell out at the worst time, at the bottom. After the crash took away half their money, that's when they're going to sell out. Even though the name of the strategy is buy and hold, you're not supposed to sell. We all know, as we've been in markets, it's not that easy. So passive investing with these index funds and ETFs is real easy when the market is going well, when everything's going up. When you start facing some volatility and turmoil though, I expect most people to sell out. And that is actually where I see these financial advisors and asset managers provide some value. Or let's just say financial advisors specifically. Now, I personally hate financial advisors. I hate almost all of them. But guess what? My best friend is a financial advisor. Shocking. Oh, drama. TNT. But here's the thing, he's actually a good financial advisor, which is very rare because most of them are just salesmen. And the more I talk to him and learn from him, the more I see where financial advisors can provide value. So as a financial advisor, one of the things you do is provide a guard in between a person and their money. So say a financial advisor tells you to buy and hold, say go into an index fund. They collect that fee, but then they're supposed to earn that fee in the market downturn because they are supposed to help you from making the stupid decision of selling out at the bottom. And if you talk to my friend, you know most of his job is just being a therapist for his clients. They come to him with everything, finance and non-finance related. So your average guy is going to need someone like that, even if they could put that money into the ETF themselves. They don't have the emotional control or the knowledge of markets, like cycles and all that, to be able to do the right thing when it really matters. That's when the financial advisors should come in. So I do think for a lot of people who don't understand markets, like a financial advisor, asset manager, if they want to charge that fee, it's worth it. And I mean, professionals who have been trading in the markets, they know. Like Darren, I think you would agree with me that most people should not be trading in the market. They should learn enough so that they don't get screwed by one of these con artist FAs. But like the markets aren't a game. I personally tell people that they shouldn't be trading or managing their money in the market unless they want to either become a professional or keep it as a serious hobby where they're basically a semi-professional. It's just like I wouldn't tell someone who's not a doctor to go operate on himself. It's stupid. And markets are serious too. Like it takes a long time to learn what you're doing. So you need to learn enough so you could correctly identify someone who knows what he's talking about, which is not the easiest thing to do either. But I don't think the average Joe who doesn't have an interest in the market should be trading. And I guess, yeah, it would be awesome if your average Joe can go and find these artist traders who are giving that respectable risk-adjusted return. But it's already hard enough to find a good basic financial advisor. Like I can't even imagine someone who doesn't care about markets trying to understand some of these strategies that do give you that good return. So I agree with Darren and I disagree in some ways. I just see the value of a financial advisor type role of not being like beating the market, but just being that therapist that people need and kind of holding their hand when things get rough. That's what I think you're paying for with the fees. And that's why I also think these robo-advisors are not going to last, because no one is going to be happy picking up their phone and talking to a robot. I don't need freaking Alexa telling me,
no, don't sell.
I would still sell. That's when the humans are going to beat out the robots when it comes to the human to human interaction, especially with the good financial advisors who have built a solid relationship with their clients so that their clients trust them. They are going to more than earn their keep with those fees if they're able to prevent them from doing something stupid in tough markets. So yeah, a robo-advisor would charge you even a lower fee than your financial human advisor, but you might not be getting what you probably don't know you need yet. Anyways, that's my take on it. Everybody, please go comment down below. I'm not saying I don't enjoy talking to myself in this empty basement, but it's a lot more fun when I get to talk to somebody in the comments. So comment down below, and if you haven't already, subscribe to this channel and hit that notification bell so that you get an email notification whenever these new videos come out. We're publishing every single day. We're all hanging out, having a good time. Join the Fallible community. Yeah. Okay, but subscribe and I will see you in the next video. Stay fallible out there. Bye.